Hi guys, thanks so much for joining me today. We're about to get started with our webinar on cash flow made easy. The webinar today is designed to be as interactive as possible. So I'd really encourage you to use the Q&A functionality to ask questions at any time. You can also use the chat functionality. So please feel free to do that. My name's Kristy Bailey. I am an advisor and presenter for Business Station, and we obviously present the ASPAS program, the Digital Solutions program. If you're not already signed up to the program, I will tell you a little bit more about it at the end, but obviously free webinars are a huge benefit of the program. In terms of my background, I'm not an accountant or a bookkeeper. So what we're talking about today is really drawing on my experience from the operational side of businesses and running small businesses. So I have, for the past 10 years or more, run my own small business. So hopefully that side of it will help you to just really take control of your cash flow. So we're going to get into it now. As I mentioned, please ask me questions at any time. All right, so in terms of the content that we're going to go through today, you'll basically be gaining an insight into the cash flow process and how you can manage it. We'll discuss what cash flow actually is. We'll talk about and you'll discover the difference or perhaps even the relationship between profit and loss and cash flow. And you'll also learn how to create your own cash flow forecast. And then also how to develop a really analytical approach to cash management by really effectively tracking your own performance. We'll then finally look at strategies to stretch your cash flow further as well. So lots to get through, but first of all, to kick us off, what is cash flow? Well, cash flow is a term that's used to describe the amount of cash or the actual dollars that is generated or consumed in your business at any given time. Now, cash flow has a lot of uses, both in operating a business and in performing financial analysis. And I believe it's one of the most important metrics in all of finance and accounting because it's really the lifeblood of your company. It allows you to evaluate the flow of funds in the business and to identify where and when, being a key sort of component of what we're doing, where and when there are potential problems. Now, once you understand cash flow, I believe it's a really key to the success of your business. And if you can find out how to manage it, you can learn then how to stretch it a lot further. Now, cash flow versus profitability, there's always a question around this. Profitability is the ultimate goal when it comes to the financial side of running a business, but you don't generally determine true profitability until the end of a period of time. So for example, the most common period of time would be a financial year. Now that's the key difference between cash flow and profit. Profit looks backwards and retrospective, whereas cash flow looks forwards. So profit will indicate the amount of money that you've got left over after all of your expenses have been paid. So like I said, the most common is going to be a financial year. Hopefully you've then got a little bit extra to spare. Whereas cash flow is really that net flow of cash into and out of a business at any particular time. Now, it could be outlined in weeks, it could be months, or you could look at cash flow over the year, depending on how you set up your reporting, but the most common is months. To look at a cash flow week to week, there's a lot of detail in that, obviously being 52 weeks in a year, so months tends to be the most common way to look at cash flow. Now, cash flow does matter and it matters a lot, but why does it matter? Well, having good or positive cash flow means that you're going to have enough money to pay all of your expected expenses when they're due. And that's a really key thing. You'll also know when you're able to reinvest in the business and potentially purchase capital or other assets that you might need to grow your business or even to run it more efficiently. You'll also be able to see when it's appropriate to return money to shareholders or even take money out yourself. In terms of cash flow and managing it, you'll also be assured that you've got a buffer to cover you against future financial challenges. Now, those financial challenges might be unexpected, and it could be something like equipment replacement, there could be legal expenses or anything that's truly unforeseen. Things do pop up, so you have to know that you can cover them if and when they do. Now, having cash flow problems means that you don't have enough money in the bank for those necessary things, let alone anything unexpected that might arise. So One thing about cash flows that you need to keep in mind, you can have profitability yet suffer from cash flow problems. So you might have clients that pay you late, or you might have early paying terms for your suppliers as well, which means that the cash is coming out of your bank. And that's generally the main reasons that cash flow issues can arise. But if you can figure out your cash cycle and your payment terms, they're the two first things that you can do to ensure positive cash flow. Now, if you've got an existing business, it's really important to continually analyze your cash flow. If you're looking at it from a startup point of view, your first goal has to be maintaining a positive cash flow. And once that's under control, then you can look at that ultimate financial goal of making it as profitable as possible. Now, in terms of tracking cash flow, this is one of the things that we're going to talk about today. Tracking cash flow allows you to operate profitably and to generate positive cash flow. Otherwise, if you can't, based on what you've tracked and what you've forecast, you'll need to make necessary changes to improve it. So you might identify that you need to reduce certain expenses, or you might identify that you need to increase revenue in particular areas. So tracking that cash flow will allow you to look at what's working well and what's not working, and at what times of year or times of a month, if you're looking at it on a weekly basis, that there are cash issues. Now, you can set budgets based on what you know you need to achieve at certain times, and then track it to ensure that you're meeting those budgets and getting the cash in that you anticipated you would. It also allows you to be sure that you've got enough cash, or determine how you can get inputs. So if you don't have enough cash, and if you're through tracking your cash flow by way of a forecast does identify that, then you might need to input into the business personally. You might need to seek investors, or you might even need to look at selling off assets to get that cash injection that you need within the business at particular times. Tracking your cash flow also allows you to make really informed decisions on various areas of your business, and that could be anything from purchasing, and it could be purchasing bulk supplies, merchandise, anything that you need to run your business. It could be staffing, how and when you staff, and what sort of staffing levels you can afford. Sales, what sort of sales you're getting in, and what you maybe need to achieve. Also, we'll look at what your equipment you're leasing or space you're leasing, etc. So with all of that knowledge, you'll be able to really reach your key business goals. Now, because cash flow matters, and it does matter a lot, it's only natural that you should try and do absolutely everything in your power to increase it. So forecasting and knowing exactly when you'll have cash inflows and cash outflows is absolutely crucial. Now, to do that, you need to map it all out. There are tons of different templates available online to be able to do that. The best that I've found are those that you can get through the Australian government websites, but yeah, there is a range. A lot of banks will have templates that you can use. Most of them are downloadable, normally in an Excel format, and they're normally free. So keep that in mind. I'll show you an example in just a minute, and we'll go through the various components on it. But once you do have your template, to get started, you'll have to decide the period that the forecast will cover. So when it starts and when it ends, and whether or not it's weekly or monthly. You'll add in all of the cash inflows and then deduct the cash outflows for each period. So like I said, typically you will find that it's month by month. If you've got an existing business, a really good way to start this is to get all of your data from previous years and input that into your forecast. And when I say data, it could be both inflows and outflows. If you expect your sales to remain the same, then that could be sort of what you base the inflows on. In terms of outflows, I would get some reporting from your accounting system, whether that's MyOb, Xero, or another accounting system. Run those reports and start inputting that data. Then you will have to decide what adjustments you'll make. And adjustments might be made on past trends. So sales might be increasing, and you know that there's a trend that is steadily increasing over time. They could be decreasing because of COVID issues or whatever that might be, or they could be staying the same. So if you're a new business, when you prepare this cash flow forecast, you'll have to really start just by estimating cash outflows. So what expenses do you know you have in terms of rent, equipment, absolutely anything from bank fees to accounting fees to insurances. So If you do that, you'll then get an idea of how much cash needs to come in and therefore what level of sales you need to make to cover the cash that's going out. Keep in mind, sales figures, always change because they depend on so many factors. Now, it could be the type of customer that you sell to, how quickly they have to pay you, because remember, a cash flow forecast is based on the timing of cash coming in and going out. It could also vary by what the economy is doing. There could be interest rate increases, unemployment rates might rise. So what your competitors are doing can impact. So there's tons of different factors that impact your sales. So be as realistic as possible when you are forecasting. Now on the screen it is an example of a cash flow forecast. Now this particular one is a monthly cash flow forecast, so it's a template. Like I said, there are a range of different templates available. This one is a particular bank template. Down the bottom on the left-hand side under the July column, you can see the opening bank balance. Now you would input, let's say you had $20,000 in the bank, you would input that as a starting point because that's cash that you have now. Keep in mind with this, cash flows are all about the timing and the flow of cash. So you have to have that opening bank balance, the actual cash you have on hand, but you also have to be inputting data based on when the cash is coming in or coming out. And that is by way of inflows and outflows. So the top section that you see in this particular template are your inflows. So you could have sales now. You could break that down by sales of different products so that you're outlining, you know, there might be 5 different products that you sell, or you could just group all of your sales together and show it on your cash flow as total sales. There could be other revenue that you get as well. So there could be, you know, anything from GST rebates or tax refunds. There could be as an owner, you might pop in an investment of cash to add extra equity into the business. So you might do that at a specific time. You know, in November, you're going to have to import $5,000, for example. There could be government or other grants and funding. You might sell an asset or anything like that. So any inflows of money, any money that's coming into the business. Outflows will then include any expenses in the business. So that could be running expenses. It could be, like I said, your accounting, bank fees, there's freight and postage, cleaning, insurance, absolutely anything and everything that you will need to spend within the business. Now, if or when you are buying new assets, make sure that they're accounted for on here as well. You might have one-off bank fees like loan establishment fees and that kind of thing. Obviously, loan repayments need to go in here as well. And if, as a business owner, you are taking money out of the business, it absolutely has to be accounted for here. So you definitely need to plan that out. And we'll talk about this as we go through the webinar today, but owners are their own worst enemy when it comes to cash flow, because obviously, you know, you do want to take money out of the business, particularly if you're not drawing a wage. But, and, you know, owners tend to see money in the bank and go, all right, yeah, I'll take some out now, but you really have to plan for it. And that way you won't leave yourself short at other times of the year. Now, the other thing to keep in mind here on the outflows is don't forget to account for your GST payments. If in the top section, in the inflows, your sales, you are including GST, you have to make sure that you take the GST out in that bottom section. Also, don't forget employee expenses. So PAYG and super, generally they're paid quarterly or it could be monthly. So depending on your cycle and how you like to pay those particular expenses, make sure that you're accounting for that at the time that you're going to pay them as well. So you might pay your employees weekly or fortnightly, but you might only pay their super and PAYG quarterly through your VAS. So keep that in mind as well. But a template is a really good starting point and it really allows you to map everything out. So I'd highly encourage you to download a template. Like I said, the Australian government website, also the Small Business Development Corporation in Western Australia has a really good cash flow templates that has both a weekly and a monthly variety or version of that particular forecast. So as a very important starting point, I would look at downloading a template and mapping out some of your cash and just see what it looks like. Okay, so now we're going to get into some strategies for improving cash flow. Once you've mapped out your cash flow and you're all set up to track it, you'll identify if and when you need to improve it. So whether there's a profit or a loss showing on your cash flow statement, you should still look at ways of improving it, because that will equate to more profit for you. So the strategies for improving cash flow fall into one of three categories. Now, there's revenue growth, there's operating margins, and there's capital efficiency. So we're going to look at some of the key areas within these three main pillars, but it's definitely worth looking at all areas of your cash flow, obviously looking at what's relevant to your specific business. So if it's something that we don't get to today and we don't go through, make sure that you do consider absolutely all areas of your business in terms of how you can improve cash flow within that specific area. Now, I believe that a lot of what we're talking about here today really comes down to marketing, and it's strategic marketing. But first, you need to understand your position to be able to improve your marketing and subsequently improve your cash flow. So to expand on those three pillars, you've got revenue growth, and that's essentially the volume of goods or services that you sell and the price of what you're selling it at. Now, going back to that template, I think a really interesting thing here is if you've been selling something at a particular price, and on your cash flow forecast, you tweak that price by, depending on what you're selling, but $1 or $2 per unit, for example, you'll see a really big difference on your cash flow, whether that's you reducing your price slightly or increasing your price. You see big changes here. So just as, in terms of revenue growth, yes, the volume of goods and services sold is really important, but the price of what you're selling it at is also really important. And some small tweaks can have big impacts. Then you've got your operating margins, which is your cost of goods sold. So having a look at those elements and what things are actually costing you. And then your selling, general and administrative expenses and what you can improve there. Then you've got capital efficiency. So that last section. Now that's really just a question of how efficiently you can use your capital and your cash to operate and grow. So looking at property, plant and equipment, and inventory as well. So we're going to go through some of those main elements. Don't forget that Q&A functionality and the chat functionality is there. So if you do have any questions, please feel free to stop me as we go. Just type those questions in and I'll answer them as we go through some of these strategies. Okay, so pricing, I touched on pricing. We'll start with that. A lot of businesses that I deal with, or when I first start working with them, don't really know if their pricing is right and if their prices cover costs, and if specific products or services are actually profitable, or if they do, some of them do better than others. So thinking about your business and your product or service, do you know what are your most or your least profitable products and services? Do you know how you can increase those products and services that are more profitable and decrease the less profitable products? And do you also know how much time is invested in each of them? So that's a big factor. You might have a product or service that is extremely profitable and it does well, but it consumes 90% of your time. So you could actually, if you increase the price of that, spend less time on it, you could potentially focus on other areas. So there's a lot of considerations there, and it's really just looking at your unique situation and asking those questions and sort of investigating that side of it. Now, when you've set your prices, now this might have been originally, or you might be working on setting your prices, but how have you defined your prices? So have you based it on a cost plus sort of basis, which is what it costs you plus a markup? Or are your prices competition based, where you're just looking at what your competitors are selling it for and then selling it a little bit under or a little bit over that? Or have you based it on what you think the customer is willing to pay? So in terms of pricing, I think you really need to look at all three of those elements to be effective. So you can't just base your pricing on what it costs you plus a markup, because it might not be competitive. Similarly, you can't just base your pricing on what the customer is willing to pay or what your competitors are doing, because you might not be covering costs or making enough profit. So you have to look at all elements. I think a really good starting point with your pricing is knowing exactly what your competitors are doing, but then also knowing your worth. So identify your strengths and your weaknesses. identify any gaps in what you're offering when you're doing that research on what your competitors are doing. So to make sure that you can really offer a fantastic product or service superior to your competitors. So like I said, this goes back to your marketing strategy. What is it about your product or service that's unique or different? And what sets you apart from your competitors? Can you charge more because of that? And when it comes to discounting, do you need to discount, base your pricing on more volume, less profit, keeping in mind that discounting means more work to make or maintain a margin, whereas you're increasing your price means less work and fewer customers to maintain a margin. By increasing a price, you could potentially cut out a market, or on the flip side, decreasing your price, you could attract the wrong market. So there's lots of considerations when it comes to pricing, and you really do have to do your research here. And this goes back to, like I said, marketing, strategic marketing, marketing 101, looking at your competitors, looking at what your strengths and weaknesses are and what your value to the customer is, and then setting your prices accordingly. Then popping it into your cash flow forecast so you can go, all right, well, this is what I know will work with my market based on my competitors, based on my target market and what they want. Now, how does it work from a cash perspective? Once you input that data based on the volume of sales and the price you're going to sell it at, you might then go, all right, well, that actually doesn't work with my cash flow, so I need to tweak it again. So it's a process of doing your research, mapping that into your forecast, and then going back and forth in that sense. So pricing is absolutely crucial to your cash flow, obviously, as is when the actual income comes in. So don't just base your pricing on sales per month unless you're actually getting the money in that month. All right, volume. Volume is really important, and we spoke about that on pricing in terms of discounting versus increasing your prices. But thinking of volume, can you increase your volume overall? And specifically, can you increase the volume of more profitable products or services? So you would need to look at profit enhancement. And to do that, we look at a few different options, and you can see that on the table on your screen. So the first one in blue is market penetration, and that's where you're selling existing products to an existing market. Now, that's when your company penetrates a market that your current or similar products already exist in. So you're basically gaining your competitors' customers. The next area of profit enhancement is product development. And that's the green that you see on your screen. That's developing new products for existing markets. So thinking about who your markets are now, can you launch a new product or service? Now that could come about as part of the research that you've done through your competitors or through trend tracking and knowing that there are certain trends that are emerging. So consider what sort of product development needs to occur. Market development is another profit enhancement strategy. Now that's where you've got, that's in the orange there, I should say, and that's where you've got an existing product in a new market. So you're developing new markets with existing products. So broadening your scope to a different market. Now, an example of this, and we saw a lot of this throughout COVID and lockdowns, is going online where you previously just had a bricks and mortar store, for example. So that is, you've got the same product, but you're opening yourself up to potentially a global market by being online. Now, the last strategy in the red there is diversification. Sorry, that's new markets and new products. So can you spread into new areas? Can you sell something different to your existing core product? So complete diversification. Now that might occur for many different reasons. Again, it could be through trend tracking, researching your competitors, going, all right, I've seen something here that I know I can make work, but I don't have this product at the moment, so I'm going to create it, and it's not going to suit my current target market, my current audience, so I'm going to find that market elsewhere. Now, in terms of volume, you also have to consider what your sales processes are like. Could better processes allow you to sell more? Are there any bottlenecks in the process? How much capacity do you have to grow? So, for example, if you are, producing a certain good, production-wise, how much can you produce in a day, in a week, in a month, and where are you at in terms of your maximum capacity? Then you've got advertising. Can you increase your advertising? Obviously, there's a spend attached to that. So that's something that you have to be very mindful of, but increasing your advertising should increase your sales. Do you have salespeople? That's a really key element. And are they good? If you do have salespeople, and if salespeople are something that works for your business, make sure that you've got, if you've got a good salesperson, make sure that you've got a plan in place to retain them, or, you know, a really good strategy to attract fantastic salespeople if you need them. The other way to increase volume is customer rewards programs. So I would have a look at what your repeat business is like, what your repeat sales are like, and how can you encourage existing customers to purchase more regularly or more through you. Now, the reason that's a key volume driver is because it costs something like 8.5 times more, I think is a stat, to attract a new customer than it does to retain an existing customer. So rather than that spend, it's really important that you are managing the customers that you've got and really doing what you can to drive more sales from those existing customers. Debtors are another key way to improve your cash flow. A really interesting ATO statistic for debtors is that small businesses in Australia are owed about $26 billion at any one time due to debtors. The best way to address issues with debtors are to collect your payments as quickly as possible, to invoice earlier. Maybe don't wait to the end of the month. Maybe send invoices straight away if you know your product or service allows that kind of process. You might not have debtors in your company at all, which would be fantastic. But you have to be really mindful if you do. Now, another strategy is to switch from paper to electronic invoicing, and even more automated follow-up services. Electronic invoices are a lot more professional than paper anyway. They're easier to send, quicker for the recipient to receive, easier for them to store. So it really reduces turnaround times. You really do have to make sure that payments are followed up promptly if they're not paid on time, though. Now, there's a lot of software at the moment, whether it's Zero Mile, that will do the automated follow-ups. So the more automated that follow-up process, the quicker you'll get paid and less time that you'll need to spend in physically, working to get those payments in. Now, you may, or may not have heard about e-invoicing. E-invoicing or electronic invoicing is the automated digital exchange of invoice information directly from a buyer's and a supplier's accounting system. So e-invoicing, with this, you won't need to generate a PDF or paper invoices, so neither. And once connected to the same e-invoicing network, you can start using accounting software like Xero and send and receive e-invoices. So they will just go straight into your systems. Now, the network is called People. So the Australian government, for example, use that. So if you're doing any government work, that's a great way of being set up on that system to get paid really promptly, because it's automatically input into their system. Now, according to the ATO, it can cost a business about $30 to produce a paper or a PDF email invoice. So that's quite a big expense just to invoice somebody and get that money. E-invoicing, that drops down to about $10 in admin. So keep that in mind. That's a really, really good idea. And I think you'll see more and more businesses going this way in the future. Reducing your terms is a really key way to get money in faster. So like I said, don't make it, we'll invoice straight away. So invoicing earlier is one thing, but then in terms of reducing your terms, making it shorter than 30 days. Some companies will give you the full 30 days to pay. And if you deliver a product or service on the first of the month, you don't invoice to the end of the month, and then you give the customer 30 days to pay. It could be 60 days before your invoice is even due, assuming they pay on time. And if they don't, that can extend out even more. So really tighten up both the invoicing time and the term of payment as well. I would also consider looking at offering a discount for prompt payment or even introducing late payment fees. It really depends on your business. There might be a bit of a negativity associated with late payment fees. So think about what's suitable to your business and what works well with your customers. But also just make paying easy. So offer a lot of different payment methods, or as many payment methods as is reasonable to your customers. So don't just force them to pay by direct deposit. See if you can get up, credit cards or merchant facilities there, BPay. Just find different ways so that they can pay the way that suits them, which will reduce that friction in terms of how and when they pay you. Assets is the next element that we're going to look at. Now, assets are really straightforward. I would simply look at if you can free up any cash by selling assets that are unused or perhaps even underused. Businesses tend to accumulate assets, and at some point you might not require them anymore. So sell those unnecessary assets. That'll give you some cash to put into the business. It also saves on costs like insurance, perhaps storage, and those kind of costs that you'll be outlaying for assets that you don't actually require. I would also recommend looking at leasing to free up cash. Does it work out better for you to lease equipment or premises even? It would then remove the cost of maintenance, remove the cost of risk of complete failure when it comes to equipment. So remember when we spoke about unexpected cash items, that could be a way to really reduce the risk there. Leasing smooths out cash flow. So if it's appropriate for your business, it can be a really good way to free up cash. Also, if you've got finance, look at refinancing, always look at negotiating better terms with any existing loans that you've got or bank agreements that you've got in place. So the asset side of things is really straightforward. As I mentioned, the other thing about assets is looking at the efficiency of assets. So you might have an asset at the moment, but, we go back to that production scenario. You might not be able to produce enough of your product with the current asset that you've got. So in terms of what you can do from a cash flow perspective, with your asset is potentially replace that asset with something that is a little bit more, that functions better, more efficiently, more effectively. So consider that as well. Now, expenses. Very simply, expenses decrease the amount of cash that's available to your business. So have a look at your expenses. Once you've mapped them into your cash flow forecast, I would go through every single expense on that and ask yourself if it's needed. Is it effective, and can you do any better with that expense? So could you defer any expenses? Could you negotiate better payment terms with any of those expenses to give you the cash longer? So let's say, you've got something that even your stock, for example, you might only have 7-day payment terms at the moment. Is there a supplier that can offer you 30-day payment terms and those kind of things? In terms of your leases and rent, could you rent a cheaper location? Could you rent cheaper equipment or negotiate a better deal with any current lease agreements that you've got in place? Think about all of the expenses that are listed on that cash flow forecast, and are there any cheaper alternatives? It could be new plans or technology packages when it comes to phones, internet, computers, software, anything like that. Can any of those expenses just be completely removed? Is there anything that you're just not using? You might have had a subscription for anything, that you don't use anymore. Also have a look at your insurances. When was the last time you reviewed those? Get competing quotes from different companies to make sure that the prices are the very best that you've got at the moment. The other thing I would look at is the comparison of outsourcing versus in-house staffing. Now, that can be a really effective for specialist roles or particular tasks within your business. So bookkeeping, particularly with more automation, you might not need someone sitting at a desk all day doing accounts, for example. Marketing, other administrative type roles that could potentially be done off-site, which may reduce the amount of space you need to lease, for example. It could be done on a lower level. So rather than an employee, it becomes an expense, or rather than a liability, it becomes an expense. So looking at that side of things, outsourcing versus in-housing, there's pros and cons for both. Obviously, as I just said, employees are a liability, whereas any outsourcing becomes an expense. So there's those benefits. but it's really just more effectively looking at ways to spend your money, or ways you can spend your money. We will touch on that a little bit more shortly as well. Now, inventory is a big one. Inventory represents cash. So if you're holding inventory for too long, say more than 90 days, it'll really cost you a lot. So in terms of your inventory, you can look to source cheaper stock and materials. Always review your pricing from suppliers and do it regularly. Get comparative quotes, as I mentioned earlier. So have a look at that side of it. Even if let's say you've got a particular supplier, you really enjoy dealing with them, it doesn't hurt to get comparative quotes. If someone comes in cheaper, you could always go back to your original supplier, give them the opportunity to match that price, but make sure that you're keeping them honest and that you're just double checking what's there in the market. Purchase power is a really key one. You have buying power when you understand your own cash cycle. So when you map out how much cash you have at certain times versus how much stock you use, you can really see if there's any efficiencies. So for example, in October, you might have a surplus of cash, and you can clearly see that on your cash flow forecast that there's always a lot more money in your business in that particular month. So can you buy bulk product, use that purchasing power to get reduced rates at that period of time to get you through a little bit longer? So look at those kind of efficiencies and using up that cash. Now, with your stock, correct stock levels are really important. You have to always maintain perfect levels. So you have to make sure that your stock isn't too high, of course, because inventory represents cash, but you also don't ever want to run out. So you don't want to get to the point where you can't supply your customers because you didn't order in time or you just left yourself short. So look at ways that you can track the movement of your stock and have processes in place to really identify when new stock should be ordered. So you could always look at if you've got stock that's unsold, see if you can return it to the supplier. You have to really know your supplier's return policies prior to getting on board with them. I would look at that information. Obviously, their payment terms and their return policies are the two key things that might even help you choose a supplier. Otherwise, if you've got stock that it's not moving as fast as you'd like, you have to think about ways that you can move it faster. The example that we used earlier is perhaps going online as well as having a store, or vice versa. You might only be online and you might have stock that you just haven't been able to move. A pop-up store could be the answer in that sense. But if you can, I would suggest using a software platform to manage your stock. You could do it manually, but just make sure that you are managing stock and you know exactly what you've got and how long it's been sitting there at any time. You've got to replace that slow moving or even obsolete stock with stock that really has that faster turnover. So understand what sells well and what doesn't. They're both really, really important elements of cash flow. Now, an alternative or a way around stock and inventory is drop shipping or just-in-time stock orders, and they can be great. You can look for suppliers who will provide you with stock only when you need it for specific orders. And that way you're not going to waste money paying for any stock that's just sitting in a warehouse or a storeroom. You only order once you've had an order from your customers, but you have to be really careful there that there's no delay on delivery to your customers. You don't want your customer service to be impacted by the fact that you've chosen that sort of way of ordering stock. So where does the stock come from? How long does it take to get to your customers? They're the key things I'd be looking at there. But if you can make that work, that can be fantastic. Use your supplier terms as well. Look at what their payment terms are and make full use of them. I did touch on that, but if you are looking at a variety of suppliers, you might even choose, if you've got two similar suppliers there in terms of the quality of their product and, the ability to work with them is good, have a look at their terms of trade. So if one's 7 days, one's 30 days, I would definitely go with the one that offers you longer payment terms. That equates to an interest-free loan for you. So make sure that you are making full use or getting the best terms, but then making full use of them. So don't pay invoices early. As nice as it is, I would make full use of your payment terms. So let's say an invoice comes in, it's due at the end of the month and it's only mid-month, but you've got the cash in the bank. Some businesses get tempted just to pay the invoice. I absolutely wouldn't. I would hold on to that money because it is that interest-free loan to you and pay it on the due date. Now, staffing. We have talked a little bit about staffing, but staffing is a key area that can become a huge expense for businesses and is quite often the main expense for a lot of businesses. Now, in terms of staff management, I would firstly look at rostering to cover demand to produce revenue. So that's obviously really necessary, but you can't overstaff either. So match the roster system to the peak periods and have flexible staffing arrangements in place to allow you to knock people off early if it gets quiet, or to get people in if it's busy. You don't want to be limited in terms of the amount of revenue that you can take because you don't have enough staff. So that's really important. Understaffing is equally as bad as overstaffing. You can, as we mentioned earlier, just look at outsourcing if there's any specialist roles that you could outsource, so you're only paying on demand as such, rather than having a full-time employee in a particular role. That could be a good idea. Flexibility of workers is really important too. Can they have multiple roles, or can they multitask when they're needed? So you might have someone in your organization that is the bookkeeper and does your accounts, but they can also sell your products. So at those times where you've got, let's say you've got a shop front and it's absolutely flat out, that person definitely has to be able to get out from behind the computer and help manage the sales as well. So flexibility of workers, multitasking and staff having multiple roles is really important. Now, aside from multitasking or having flexible workers, maximum utilization of staff is crucial. So making sure that you've got targets in place to maximize their productivity is a really good idea. Incentives work well in that sense. It could be commissions. You could reward staff behavior that improves cash flow. For example, you set specific targets to reduce expenditure is another idea. Any commissions or incentives are a great way to increase sales, but another key thing when it comes to cash flow, make sure those commissions are only paid when you've got the money. Otherwise, again, you're going to be giving money out before you've got it. So let's say you've got someone on a commission basis, they get a percentage of your sales. They would only get that once the invoice has been fully paid. So that's a really important factor. The other thing in terms of staffing is making sure that your staff are qualified. So paying a staff member that's more qualified can really increase your sales as well as your customer satisfaction. And that in turn creates positive word of mouth, repeat customers, and more revenue. So unqualified staff may look like a really quick win, particularly on your cash flow forecast when you're looking at reducing wages. But in fact, it can be really damaging in the long run. Now, a good example of that I tend to find quite often is in hospitality. You could have someone that's paid a lot less, fairly junior, waiting on tables, for example, and then you start to ask them about the menu and the wine list, and they get a little bit stuck, and they don't have, they don't have the ability to on-sell and upsell you, and it can impact your experience, but it really impacts how much money you spend as well. So making sure that you've got good quality staff, if you have to pay them more to get them and keep them, it's really, really important. And retention, last point on that slide on your screen is retention is key. Reducing staff turnover is a huge goal because it has a major impact on your bottom line. Staff are expensive to hire. So you've got all of the advertising costs, the process of sifting through resumes, and the time that it takes to interview and then train these people. Like I said, there's huge costs in that. If once you have staff that are the perfect fit for your business, I would do absolutely anything and everything that you can to retain them, to keep them, be the employer of choice, because it really does impact your bottom line. So that's staff. And that covers all, well, not all, but some of the different strategies to improve your cash flow and some of those core different strategies. As you go through and complete your cash flow forecast, keep them in mind. And then when you get to the point that you've determined if you've got a profit or a loss, you'll have to make some considerations. When it comes to profit, don't be too quick to take that cash out. Invest it back in to manage cash flow in future months or years or periods of time, or even use it to pay down debt, so that that improves your overall cash flow. If your forecast happens to show a loss, you'll have to look at if and when you can input your own money. If you aren't able to input your own money, you might have to seek equity from investors. You may even have to borrow to fill gaps. So look at speaking to your bank. Even things like an overdraft. Overdrafts are really common and very simple to set up for small businesses. A very, very common solution to seasonal businesses, or even if there's cash flows with payment terms versus stock, as we mentioned earlier. So have a look at those few options. You have to keep in mind that getting equity from investors, getting your own money to put in, or borrowing from the bank takes time. So this process of forward planning is so important to make sure that you really have factored that in. You've given yourself time to look at the best options for you. You don't want to get to October and go, okay, now we've got no cash and I can't pay my bills. What am I going to do? This is all about forward planning, being organized, and making sure that you're doing everything from a real strategic sort of perspective. Then the final step, or the most important step, I think, is to review what you've estimated in that forecast against actuals. So I would suggest that you go back and check against the actual cash flows for each specific period. And that should be as simple as your sales reporting through your accounting software, and looking at tracking your expenses and that expense reporting. When you do that, you can highlight any differences between what you estimated and what your actuals were, and look at why your cash flow didn't meet your expectations. So it could have been a number of factors, but it could have been something obvious. It could have been lower sales, for example, or it could have been higher expenses. There could have been expenses that you didn't expect that popped up. So I would analyze what the situation is, and then you may have to take action again for different situations. If, let's say, something unexpected did crop up in the month of, where are we now, September, then in October, you might have to review the whole cash flow and go, all right, do I need to input my own money, get equity from investors, or borrow to fill gaps? Is there something there that I need to consider? Or will it balance out because, maybe an expense has just come forward. It's something you normally incur in December, but it's come through in September for whatever reason. So thinking about that. Now, keep in mind, cash flow is all about timing and the timing of that movement of cash. So when you prepare this cash flow forecast, and when you're mapping it all out, make sure you're as accurate as possible on that specific timing of cash flows. And then it will all make sense when you're comparing the forecast to your actuals. Otherwise, there'll always be gaps, and you'll be continually analysing why your projections aren't meeting your actuals. So keep that in mind. Now, in terms of cash flow mistakes, the biggest and most common mistakes that I see, first of all, running a business from your bank balance. So it doesn't account for any planned or unplanned expenses, perhaps the seasonal nature of your business, if you've got a high season and a low season. So it really doesn't give you any kind of business picture. So make sure that you don't worry about what's in your bank. Have a look at what's planned. Obviously, you need to worry about what's in your bank, but don't base any business decisions off what's in your bank at any particular time. Now, improper management of taxes and other government expenses is also a big mistake that I see. These expenses are clear, they're known, so you can plan for them. So I'm talking about GST, super, PAYG. Keep in mind there's penalties for late payments. It is very simple to account for these taxes, so do it in the planning stages. Spending too much money on sales. As a small business, you absolutely need new customers, but you have to consider what cost what the cost is to obtain those customers. Are you tracking an acquisition cost of a customer? Do you track the total revenue that each customer generates you? It has to be higher than the acquisition cost. Overspending on that acquisition might lead to gaining like a small value customer, for example, that has a limited return. Now, a lot of businesses have issues with this because they think that the more customers they get, the higher the profit will be. And it's not always the case. If you're discounting, you might not be making much of a profit, if any. So that's where it comes back to your pricing, understanding how much each item costs you to produce, or each service costs you to deliver. Having a look at that cost of sales is really important. Know your value, but know your acquisition cost, and then that'll sort of help you in the pricing phase of how much you can charge or how much you can discount. Not forecasting is a massive mistake, but that's obvious based on our discussions today. So I hope that you won't make that mistake, and that you'll use this opportunity to really look at your cash flow and track it and map it out. Not collecting cash fast enough is an issue. If your customers are delaying payments, but your supplier terms are short, then you're the one that's caught out in the middle. So unpaid invoices are actually also cash flow killers. And that's, late payments obviously is an issue, but some businesses miss out on even raising invoices. I've personally found that several businesses that I've dealt with have forgotten invoice here and there. Now, I'm always honest, and I'll let them know to invoice me, but I've had a company that I've followed up 3 or 4 times and just said, send me an invoice. So you really don't want to be there, because I'm sure there's a lot of businesses that maybe don't follow up. So as a small business, make sure that your systems, your processes and your procedures are tight enough that there will never be the scenario of someone not getting invoiced. Another cash flow mistake is holding inventory for too long. It does cost you money. As we discussed, inventory represents cash, so don't let it just sit there doing nothing for your business. Taking too much cash out of your business is also a really big mistake. Thinking about your business, do you take money out of it sporadically, or do you do it regularly? And can you actually afford to take it out? I know, as a small business owner, you work hard and you absolutely deserve to take money out and to earn money for your business, but you have to account for it and plan for it. Now, if you do all of this tracking and you have a look at all items here and ways that you can improve your cash flow, you might see that you suffer from a negative cash flow position. There are things that you can do about it. So first of all, you have to find out what caused the issue and see how you can fix that. Obviously, change your payment terms, reduce your operating costs, and then potentially run promotions to get new sales. So the last item there with a negative cash flow is obviously meet with a lender or investor, but go through this extensive process. It takes time, but it's absolutely worth it in the end. Okay, so that wraps up the session on cash flow. I hope it makes sense to you, and I hope there's some things that you can take out of it to improve, or at the very least to better understand the cash flow position in your business at any given time. I'm going to stay on now and answer any questions. So if you do have any, please drop a line in the Q&A or the chat functionality, and I will answer those straight away. If you want to know more or talk about any other aspect of your business, you can book a one-on-one appointment. Now, there's a new program. Some of you may be signed up to the program already, some may not be, but the program for 7 hours of one-on-one consultations and a combination of one-on-one consultations and workshops and webinars, it's just $44 as supported by the federal government. So please ask me and find out more about that particular program. Now, someone's just asked a question about their cash flow forecast and what site that is actually on. There's the Small Business Development Corporation has a great one. So you can just Google Small Business Development Corporation or SBDC cash flow forecast. Otherwise, business.gov.au is the Australian government website, but Google cash flow forecast and look for any .gov.au sites. They'll be the best ones for you. But my personal favourite is Small Business Development Corporation. Thanks so much for your time today. I hope that we get to chat again soon. Like I said, if you're interested in registering for the program, please get on and do that. There's a lot more great webinars, workshops, and obviously the one-on-one appointments that you can benefit from. Good luck with planning your cash and your cash flow management. I hope that you all do extremely well in that sense. And like I said, I hope to chat with you again soon. Have a great day.